You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Hello and welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Option Analyst and author of the Options Playbook. All right. So last week, we took a little time off to answer some of the listener questions. Mark and I did a huddle up, had a very good conversation last week. Always love it when we take the time to answer the listener questions. Actually, those are a lot of times my favorite shows. They're the simplest ones to do just because we get such great questions from the listeners of Options Playbook Radio. And I want to thank you. We're going to look like we're going to have over 2 million downloads of Options Playbook Radio this year. So I got to be very thankful for all of the fans / listeners / investors / option traders that are out there that are making Options Playbook Radio what it is. So a big hand to all of the listeners out there. And a big thanks this week after Thanksgiving. Okay, so with that said, we're going to start anew, and it will be a very simple trade, simple and straightforward trade this week. We won't be reviewing the trade. A couple weeks ago, we did an Iron Condor, pretty straightforward on the Iron Condor, and that trade is already passed, so we're going to move right on to Disney. Everybody's starting to get excited about Disney, They don't really think that it has great valuations, trying to decide, are they theme parks? Are they Disney Plus? Like, what is Disney all about? Bottom line is Disney's had a really tough time, even since the pandemic, when they luckily announced Disney Plus prior to the pandemic, or basically right when the pandemic was kicking off, and got a lot of benefit from that because of an online streaming service. But their theme parks have struggled. So because of that, let's bottom fish. Let's look at, once again, a fear of missing out. My favorite fear of missing out strategy, if you've listened to Options Playbook Radio before, is the fig leaf, where I'm going out further in time, buying a deep in the money option as a surrogate for the stock. So, well, before I get too far ahead of myself, let me state that today is Wednesday, November 30th. The markets are closed. Disney rallied with the market today. Fed Chair Jay Powell spoke today and basically stated that a slower pace of rate hikes is possible, considering the data and the news that has came out this week. It's been a lot of news, but overall, we'll just leave it at that, because that did spark a rally in the markets, and the Dow was up over 700 points on the day, and the SPX climbed over 3%. So we're going to take that news. We're going to run with it. We're going to run right to Disney, symbol DIS. Disney closed at 97.86, up about what the S&P 500 index was up. It was up $3.17 or 3.35%. So quite simple. The fig leaf is a strategy inside the playbook that we just named. A lot of people think of it as a leverage covered call. There never was a name that was made for this strategy, so I think it deserved one. So as opposed to just saying that we're going to buy a deep in the money covered call and sell a short-term call against it, we'd call it a fig leaf. Why? Because we're kind of covered. Not quite like a covered call in that you own 100 shares of the stock. You are actually buying an option as a surrogate for the stock. So we're going to buy something with a lot of delta. It's going to be a fairly expensive option relative to at the money or out of the money option contracts, but you get what you pay for. And the concept would be is that if you were going to buy 100 shares of Disney, you would buy one call option. We would limit our downside risk. We have a longer time frame that you're looking at. And then once we put that long call position on, we'll look at selling a short call against it. Hence, we're covered because we will own a strike that is lower than where the stock is at, and we'll be selling a call that is out of the money that is higher than where the stock is at. So you have the right to buy it lower, obligation to sell it higher. So you're covered, but you're selling different expiration dates. And if you do get assigned on that front month, you do have some risk. You're going to, the broker's going to say, you got to give us the shares. You don't have the shares. So what do you do now? Well, you could exercise your long call option, but you have a lot of time premium in that long call option, most likely. If you don't, if it's way deep in the money, then there's no real concern if you want to exercise it. But if you do go out and exercise it and have time premium, you're leaving some money on the table. So the thought would be that you're going to actually sell the long-term option and go out and buy the stock and deliver that stock for the short call option. That is the way it all works. And hence, we came up with the fig leaf because, quote unquote, the tagline is inside the options playbook under the fig leaf strategy. You are kind of covered. And I'm using quotation marks, which you can't see right now. Finger quotation marks, I should say. All right, so here's the strategy. It's going to be straightforward, so I thought I'd go in a little bit of detail on the name since we didn't have a trade to review this week. We're going to be going out to the April 21st expiration. We're going to buy the 142-day call. We're going to buy the 85 strike call. Disney has decent markets, and that's always very important if you're thinking about buying deep in the money leap options. So the market on the 85 strike call is wide, and it normally is, but not as wide as it could be, especially considering the markets are closed. We are 1770 bid by 1795 ask. We have a delta of 78. So we're paying $1,795 if we pay the ask for that. And I guess we'll just ride with it on the ask price. You might try to work it a little bit. Maybe you could get a little bit better fill in the middle. It's harder to do when you're just buying an individual option contract. Now, if you wanted to, you can throw in the second leg on this trade. And I don't mind doing that in this case with Disney. Normally, I would buy the long option and then wait and sell the short call. But with that said, today we're just going to bill it as 100% a fig leaf. So the call option that we're going to look at selling is going to be a very short-term call option. We still got a lot of volatility in the marketplace in general, and Disney has it also. Disney's trading at a 30% implied volatility. The option contract that we bought that's long-term is actually trading right around 35%. So a little bit longer going out, further out in time, we're actually seeing higher implied volatility than the short term. But the option contract that we're selling, trading right around 30% implied volatility, it's the 105 strike call. The market is 50 by 52, extremely tight. And we'd be looking to sell that right at the bid then, right at 50 cents. So if we did this trade and I look at the Ally Invest option strategy workbench, we're going to be buying the Disney April 21st 85 strike call, and at the same time selling the Disney December 16th 105 strike call. We're going to do this trade. If we can do it at the midpoint, because we are going to be working both legs, so maybe we can. The midpoint price is $17.32. Our total risk on this trade would be $1,732. And that's versus buying 100 shares of stock. With the stock trading at 97.86, you're looking at $9,786. So we're greatly reducing our risk on this trade. We're in the fear of missing out stage, I think, on Disney. I think we can say we're there. There's enough pundits in the marketplace that have been basically recommending Disney all the way from 130 on the way down. And we finally broke below the 100 level once again in Disney. So why not use options to limit your risk and participate in a potential upside on Disney? We're going to sell a call against it, even reducing our risk a little bit more. And I should probably highlight the fact that I did say we're selling the 105 call that is trading for 50 cents. If I own the underlying stock, I'd probably sell something with a little bit more meat in it. First of all, you're not as worried about getting assigned. So maybe I'd sell the 102 strike if I had 100 shares of stock, and that 102 strike is trading at 108 by 112. So maybe you get $1.10 for it. But in that scenario, I'm not as worried about being assigned because I have the stock. If I fall asleep and you take it away and I buy the stock at 97.86 and I sell it at 102, so be it, right? In our scenario, we really don't want to be assigned. And we didn't pay as much for our surrogate stock or deep in the money long call option. So because of that scenario, I don't mind selling a little bit cheaper option contract. And we're going to go up 3 strikes from the 102. We're going to go up to the 105, sell that for around 50 cents. That's what the bid price would be at. Our net on our trade for this week is going to be $17.32. Okay. I'll go back and recap that one more time. But I just want to talk a little bit about just my thoughts on a fig leaf. If I do this trade and it goes up and it gets to 105, well, I'm going to have to do something. It's only got 16 days till that first expiration date. Not a lot of time, but if it does get to 105, you want to roll it. You don't want to wait till it gets to 110 to roll it or 115. It's one of those things that if it gets too deep in the money, if it did go in the direction you wanted to quicker than 16 days, well, either you're going to close out the entire trade when it gets to 105, or you're going to roll your option up and out in strike, which is very feasible. So if you're looking to do that, there is a section inside the options playbook about managing your positions, and it just talks about rolling covered call options. And that's what you're going to want to look at, the rules, when you want to do it, and just highlight that area. So if you've never done a fig leaf before, that's going to be required reading. And as always, I always have to emphasize this, that Options Playbook Radio is all about learning. It is not meant to be a recommendation by any means. So we're looking at the conditions in the marketplace, trying to apply a strategy that would work well in the current market environment. All right. Well, it only really works well if Disney goes up, right? But with that said, then that's what you look at on the upside. But now on the downside, you kind of have your own stopping point when you look at a fig leaf. I'm always going to make note of the strike price. And if the market comes down to 85, I'm going to get an alert that the stock is at 85. Not as worried about the actual price of the option contract. I just want to know that if it comes down to 85, guess what? That long option contract is going to be an at-the-money option contract. And I'm going to get the benefit of all the juice that is located on at-the-money contracts. So if the market did come down to 85, that's going to be my out point. I'm just going to sell the option at that point in time. We're looking at this, well, let's call it around 13 points below where the market is at right now, rounding up a little bit. But if it does get to that level, that's my stopping out point. That means that on the way up, I pick up delta. Actually, I get my option acts more and more like the stock. The delta is going to slowly approach 1. But on the way down, I get less and less acceleration. If it came down to the 85 strike, delta is going to go from 80 cents down to around 50 cents. And because of that, that means if I'm correct, and let's say it goes 17 points to the upside, I'm going to be more beneficial on each point movement to the upside than detrimental on each point movement to the downside. So, like I said, if the markets were tight in deep in the money option contracts on every underlying, this would be by far the most popular option strategy out there. The biggest issue is that you got to pay a real bid-ask spread. Right here we have a 25-cent bid-ask spread on a $17.90, we'll call it an $18 option contract. On a percentage basis, that's significant. So as opposed to buying the stock that is 1 cent wide. Okay, let's finish by doing one last review. Okay, so it is Wednesday, November 3rd. The markets are closed. Disney closed at $97.86 today, $97.86. The option contract that we're going to buy is the April 21st expiration, 142 days away. We're looking to go for a 78 delta option contract. That would be the strike price 85. We're going to be buying that option contract. And at the same time, we're going to enter this all as one trade. We're going to look at the December 16th expiration, which is 16 days away. And we're going to sell the 105 strike call. That is 50 cents by 52 cents. Net, if we put this trade in, the midpoint price of this fig leaf is $17.32. That's $1,732 plus commission to put this trade on, and that would be your max risk. That's it for this edition of Options Playbook Radio. If you have any topics you'd like to discuss on the show or any questions you want to ask me directly, send them to me at theoptionsguy@invest.ally.com. If you'd like to learn more about all of the educational events we do over here at Ally Invest, please follow me on Twitter. My handle is @BrianOverby. Thanks for coming. See you same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.